So, you've got a chunk of money saved up and you're ready to put it to work. But then you hit that classic crossroads. Do you jump into the market all at once, or do you wade in slowly, bit by bit? It's a huge question for any investor, and today we're going to crack the code on these two very different ways to build your wealth.
Okay, but before we dive in, we have to get the important stuff out of the way. Just a quick reminder that this is all for educational purposes. We're breaking down concepts, but this is definitely not investment advice. You should always talk to a qualified professional who can help you make decisions that are right for your own situation.
All right, let's get right to it. Imagine you've got a bonus from work, maybe an inheritance, or just some savings you've worked really hard for. The decision you make on how to invest it, all in one go or spread it out, can make a massive difference down the line. This is the core dilemma we are tackling today.
So, to figure this all out, here's our game plan. First, we'll look at the two paths you can take. Then, we'll get into the nitty-gritty of how they actually make money. We'll see how they hold up when the market gets wild, weigh the risks versus the rewards, and then finally, help you figure out which path could be the one for you.
First up, let's get a proper introduction to our two main strategies. You've got the slow and steady approach on one side and the big, bold, all-in move on the other.
This table gives us a really great bird's-eye view. You see, the Systematic Investment Plan, or SIP, is usually a great starting point for beginners. You invest periodically, you don't need to be a market timing wizard, and the risk is generally lower. Now, lump sum, that's a one-time shot. It's often better for experienced investors who think they have a handle on the market, but yeah, it definitely comes with higher risk.
So let's break down what an SIP actually is. The easiest way to think about it is like a subscription for growing your wealth. You just commit to investing a set amount of money, maybe $50, maybe $500, every single month automatically. It's all about discipline. You're not trying to outsmart the market. You're just consistently in the game.
And a lump sum investment? Well, it's the exact opposite. This is when you take a big pile of cash and put it all into the market in a single transaction. You're making one big play at one specific moment, hoping you've picked a really good time to get in.
So you might be wondering, how does an SIP actually handle risk, especially when the market is going up and down like a yo-yo? Well, the answer is this really powerful concept. It's kind of the secret sauce behind the whole SIP strategy.
And that secret sauce is called rupee cost averaging. You also hear it called dollar cost averaging. The idea is simple but brilliant. Because you're investing the same amount of money each time, you automatically buy more shares or units when the price is low and fewer when the price is high. It naturally smooths out your average cost over time and takes away all the stress of trying to time the market perfectly.
Let's see how this actually plays out with an example. Meet Priya. She's putting 1,000 rupees into a fund every month. So, back in April, the price per unit is 27, and her money gets her about 37 units. But look what happens when the market starts to fall. By November, the prices dropped to just 15. Now, that same 1,000 rupee investment gets her almost 67 units. She's buying more and more right when things are on sale.
So, who wins in this falling market? Well, Priya's patient SIP strategy really pays off here. With her SIP, she ended up with nearly 400 units. If she had gone all in with a lump sum in April, investing the full 8,000 rupees when the price was at its peak, she would have only owned about 296 units. The bottom line? Even though the market went down, her investment is worth over 1,500 rupees more. That is the power of cost averaging.
Okay, so that was a falling market. But what happens when things are looking up, or when they're just chaotic? Let's put these two strategies head-to-head in a couple of other scenarios.
First up, let's picture a bull run. The market is on fire, everything's going up, and everyone is feeling optimistic. How do our two approaches do here?
And this, my friends, is where the lump sum investment gets its time in the spotlight. Think about it. If you put all your money in at the very start of a long climb, your entire investment gets to enjoy that ride up from day one. You're not slowly adding money as prices get higher. You're fully invested from the get-go, which can lead to some seriously impressive returns.
But let's be real. Markets rarely move in a perfect straight line. So what about a more typical scenario? A choppy, volatile market with lots of ups and downs.
This is where the SIP strategy really shines. Research shows that when markets are choppy, SIPs tend to give you better risk-adjusted returns. Now, what that means in simple terms is for the amount of stress and risk you take on, you get a better reward. That process of buying at different price points just smooths out the journey and can save you a lot of anxiety.
So it's pretty clear that there's no magic bullet here. It really all comes down to a fundamental trade-off between risk and reward.
Let's dig a little deeper into what you're actually signing up for with each of these. This SWOT analysis really tells the story of the lump sum's high-stakes nature. The strength, the potential for a huge payoff if you get the timing right. But the weakness, the threat, is just as big. If you guess wrong and invest right before a big drop, your entire investment is exposed to those immediate losses. It's a strategy that requires a strong stomach for sure.
But SIPs are not risk-free, and it is really important to understand that. In a long, grinding bear market, you can still lose money. And while cost averaging helps in a downturn, it's not a shield against the sudden, steep market crash. And maybe the biggest risk of all, your whole strategy is only as good as the fund you pick. A bad fund will still perform badly no matter how disciplined you are.
Now, here's a really interesting plot twist, especially for those of you investing for the long haul. An analysis from ET Money found something pretty surprising. If you're investing for more than 10 years, the whole strategy of trying to buy the dip, throwing in extra cash when the market's down, it actually doesn't improve your returns all that much compared to a simple, boring, consistent SIP. It suggests that over the long run, consistency really is king.
Okay, we've gone through the mechanics, the performance in different markets, and the risks. Now let's bring it all home. How in the world do you decide which one is the right fit for you?
So take a look and see which column sounds more like you. Are you someone who values discipline and prefers a less stressful, long-term approach to building wealth? Then the SIP is probably your best bet. Or do you have a higher tolerance for risk, a good understanding of the market, and you're looking to capitalize on big moves? Then a lump sum strategy might be more your style.
So what are your next steps? It's pretty simple. First, be really honest with yourself about your goals and how much risk you can actually stomach. Second, think about if you really want the full-time job of trying to time the market. And finally, make sure your strategy fits your life. If you get paid monthly, a monthly SIP just makes a whole lot of sense.
And that brings us to our final question for you to think about. Now that you understand the two paths, what kind of investor do you want to be? Are you the steady accumulator, patiently building your wealth piece by piece, month after month? Or are you the strategic striker, waiting for that perfect moment to make your big move? The choice is all yours.